Sure thing.
I'm honored to be joined by Jeff Witherell, the CEO of Plymouth Industrial REIT. We got a lot to talk about here as we just wrapped up NAREIT. I hope you guys had a good conference. I'd love to get your take. Unfortunately, I had to cancel, so I was unable to attend last minute, such is life. You guys have been very busy. Right before NAREIT, you announced a big deal in Atlanta. You've got this big 6th Street JV. There's all sorts of things to talk about. So what I thought we would do is we would set it up. I've got a presentation here. We'll walk through the mission, your focus, the strategy, positioning. We'll look at onshoring and reshoring. Got a handful of questions for you. We'll obviously open it up to audience Q&A. If you have questions, feel free to put them in the chat. But the goal is obviously to record this. We're doing this interview, and then hopefully for the folks that come by and watch this afterwards today. So with that, Jeff, thank you so much for joining us, and let's talk about Plymouth. You guys have a very easy story, I think. You focus on single and multi-tenant industrial properties. You provide functional, cost-effective, flexible space for them. As of your last earnings release, 133 properties, 204 buildings, 30 million square feet. Same-store occupancy just a tick under 95%. Weighted average lease term of 3 years. And escalators in place of around 3%. Obviously, when it comes to real estate, Jeff, this is where I know you love to talk about location, location, location. And you have this great presentation in your new investor presentation from NAREIT that obviously highlights your golden triangle presence. And we've talked about this before. I think you used the smile analogy in the past, if I recall. But can you maybe walk us through a little bit about just so you can kind of see the couple of slides? Golden triangle presence, your portfolio diversification, as well as maybe call your focus on Class A or Class B versus Class A and what you're seeing there. We'll cover that for this section. How does that sound?
Yeah, so in the golden triangle, we didn't necessarily coin that term. You can see we make reference to the person who did. But basically, the way I describe it, you can see it on the screen. But if you're just listening, it starts around the Great Lakes. It's going to go southwest to Texas. It's going to go east over to Florida. It's going to go back up to the Great Lakes and pick up part of the Carolinas and over there. So it's not a perfect triangle sometimes. But it captures, as you can see, about 70% of the population. The reason we're focused on it is that the preponderance of new manufacturing development, kind of the mega projects, if you will, in the United States, are taking place within this triangle. So you look at the states like Tennessee, in Indiana, Ohio, down into Florida, across over to parts of Texas. I mean, that's where these mega projects are going. They're going there for a reason. You can get into a lower cost of living. There's a lot of skilled workers in this location. What I like to look at is one of the bigger drivers for onshoring and reshoring about where it's going to set up is about infrastructure. And so some of these, what can classify as older cities like Chicago and St. Louis, Memphis is a big market for us. And Atlanta is kind of a newer city, but in those markets, that's where you have the infrastructure. That's where you have the water, the sewer, the gas, the electric. You've got the railroads, you get the interstate system, you get the modular systems, like you're going to have Rickenbacker Airport in Ohio. You've got deep water ports on the Mississippi in St. Louis and in Memphis. And so that type of infrastructure is irreplaceable. And they're just not really building more railroads in this country. So I think as we move into the future, the next 10 to 20 years, if we're going to reshore and remanufacture America, it's going to have to take place where the existing infrastructure is. And so that it's primarily in the Golden Triangle.
Okay. Let's talk about maybe your diversification by industry and market, since you guys cover a variety of different, let's say, footprints. Can you maybe shed some light on, let's say, the ideal makeup, why you guys have a position the way that you do, and where maybe we could see, again, maybe putting on those 5-10 year binoculars, what this could potentially evolve to?
Yeah, so we focus on what we call utilitarian rectangles, right? So our buildings can accommodate a host of uses. Now, in the industrial sector, you can start to classify different buildings by the way they're structured. For instance, you can be cross-docked, so that means that you have dock doors on both sides of the building. Usually, you have multiple docks. That's kind of a high throughput distribution. So product's not sitting there to be picked over by robots or anything like that. It's product moving in. Sometimes it's moving out that day or that night. High throughput distribution. You have other buildings that are where you drive in and you're going to unload heavy product, somewhat of a flatbed driving in. That's more of a warehousing building. You're going to store product in there. It's distribution, but it's just not high throughput distribution. You bring heavy product in from overseas, let's say, or other parts of the country. You're going to bring it into Ohio. You're going to store it there, and maybe once a week you're bringing a product out and bringing it to Indiana or Columbus, Cleveland, Cincy. You're bringing it around. That's like a warehousing distribution. Some buildings are, very focused on light manufacturing. So maybe not as many, drive-in doors, but plenty of docks to, bring product in and have it exit. One of the things that we don't specialize in is in the big logistics centers, right? The big 40-foot clear, 1,000,000-square-foot buildings where you're setting up shop in there and it's going to become a logistics center. Sometimes that's special use, especially if you're going to build 1,000,000 square feet for one tenant. Then you have that binary risk that it's hard to go multi-tenant once you set up a building for single tenant if you build it that way. So we try to avoid big logistics centers.
Can I ask a question as a follow-up to that?
Sure.
Since you're going down this road? What about, we read a lot about multi-story, the next generation of multi-story industrial with like the curved ramps to drive up and stuff. What does that look like?
I mean, I think it's less than 1% of the inventory. I don't think it gets much more than that, simply because of the cost. I mean, if you think of the cost, just to build from 34-foot clear, which is a lot of what we would build new when we do new build, very few tenants need 40-foot clear, right? They're just not racking that high. Those, again, are more logistics centers. So when you get into New York, inner city, where land is really expensive and you can go multi-story, it's going to make a lot of sense to do that. But if you go to Ohio or Indiana, or really any of the markets we're in, the cost advantage of trying to do that versus just going out horizontally, it's not going to make any sense. That construction is very, very expensive.
What about, let's say, renovation of 1970s vintage industrial that isn't considered modern today? What about, how does that look? Is there opportunities, not just necessarily for you, but for the other REITs? Like, is that something to look at, of modernizing some of these older facilities?
It is. I think a lot of people get concerned about clear height. If you go into our buildings, I've never heard a tenant say, well, we're going to leave because we need a higher ceiling height, right? That, like, depend on the use. So like I said, when you're just going to do normal racking and take it down by forklift, you're not going to go 36, 38, 40 feet in the air. It just doesn't really happen that way. So when we talk about modern amenities from our standpoint, it's going to make sure that the truck courts are adequate size. It's got adequate power. Now you're starting to see more environmentally controlled warehouses where they want, i.e. heat or air conditioning. So that's like a modern asset that way when you have the environmental conditions in there. And so, you can renovate a building for that. It becomes expensive to add all the insulation and what have you. And then adding docks and making sure that there's adequate docks in there. The second part of that is, to take an older asset that is 1,000,000 square feet and to try to turn it into like 4 tenants to do multi-tenant. That's expensive. When you start breaking up the concrete floor and you need to move water and sewer and gas and power around a facility like that, a lot of other things that get missed is the lighting, security systems, and the big one is fire suppression. So to go in and to make a fire suppression system, for multi-tenant, it's very costly. So there are opportunities to modernize buildings, it can be costly. You have to buy it at the right basis, but those are certainly things that, if that building is going to be in the right location, I do think those are opportunities into the future.
I always talk about how important it is for advisors and investors to go to the REIT's investor relations pages because you guys provide so much transparency. As I mentioned, a lot of the slides I'm using here is directly from your investor presentation that you just put out there. And you have this great comment looking at your golden triangle occupancy, where you say that, the industrial sector is seeing increasing vacancy, but yet our markets all recorded positive absorption. Break out the sweet sauce for us, because you are in some very desirable markets here that obviously you have a lot of competitors from the world of REITs in some of your backyards here. So without revealing too much, but like, what's the sweet sauce here?
Yeah, I mean, part of it's building size. I mean, I think you can see that in this chart. This is mostly just, again, most of your Class A assets are larger, bigger box product. However, the contradiction in that statement is that we've built 6 buildings that are all under 250,000 square feet. So those are all brand new Class A buildings. So it's the way we categorize product in this industry. It's not as detailed as maybe it could be, but when you look at Indianapolis, for instance, if you are in where we are in our market, which is more core Indianapolis, the vacancy rate is 3.5% to 4%. When you get to the big box product on the east side, I mean, you're getting into 15, 16, 17%. So I would classify it more as the bigger box product is where the vacancy is. So go back to why do we have so much vacancy in big box? That's primarily because what was developed over the last 5 or 6 years has been primarily big box product. If you look at what a developer does, they put in the lowest amount of equity as they can. They borrow as much as they can. They want to build as big as they can so that they can take their equity and get a bigger multiple on it, right? So if you build 700,000 square feet and you can flip it at a good profit, you're going to make more money than if you build 100,000 square feet, right? So the developers have been, predominantly, especially in places like Arizona and Texas and California, just gone out and built really big box product. In parts of Indianapolis, the same way. Way on the east side, the really big box product is suffering big vacancy. By definition, there are more tenants for small space than large space.
Well, it's interesting you say that because, I mean, I don't know when the last time was that you flew into Dallas. I know you're not here necessarily, but into Dallas. You will be in December for NAREIT. Yeah. Look forward to seeing you in my backyard. But you fly into the airport and it's all the big mega properties that you're talking about owned by the big boys, the Blackstones, the Prologuses, your REIT brethren like East Group, First Industrial, Lexington, or LXP, whatever. Yeah. It's the big boys that have this big footprint. And every time I see this development, I ask myself, who's filling this space? Who's going to take down, there's not 100 Amazons that are taking down million square foot properties. And as you said, the cost to go in and put walls to break this up for some of these big projects, it's interesting because I think back to my early Green Street days 25 years ago when spec development became a real big push. And some guys did it great. Some guys didn't do it so well. And those that didn't do well were sitting on a big bag of vacancy there that they had to go eventually flip the properties to the guys that could fill that space. So, I don't know what you're hearing, but we've heard a little bit of spec development that's out there right now, at least I think. It's just kind of interesting to see where that puck is going.
Yeah, I mean, it's starting to get absorbed like it will. I think the drivers that we can talk about or have talked about and continue to talk about every day, the drivers of one of the drivers of industrial real estate is e-commerce. And so, I think we're at a 21% penetration. I think we were at 24 right after COVID, dropped down a little bit. We incrementally increase a little each year. And I mean, the only predictions I ever see is maybe 30% penetration. And everyone has a different formula for each square footage of taking away from retail and going e-commerce, we need exponential amount of industrial, but it's a huge amount. I mean, to go from 21% to 30% penetration, it will mean hundreds of millions of square feet of industrial space is needed. And some of that will be our product that could be smaller, newer, older, doesn't really matter. And some of it will be the big logistics centers, right? So some of these million square foot, 40-foot clears, will be taken up. Logistics centers will get set up in there for distribution. And I think eventually it all gets absorbed. So e-commerce.
We've started unpacking it a little bit as far as like the strategy. And you kind of talk about looking at replacement costs. I think is a key driver for one of your decisions here. We also look at your value add strategy, and then also I focus on 6th Street because I think your partnership is a little bit different than your typical let's go partner with Nuveen to go out and buy properties. I think you guys are doing it a little bit differently. And then also tier 2. You spend a lot of time talking about tier 2. So why don't we unpack a little bit about, more into the actual strategy angle here. Maybe we could use Atlanta, one of your most recent deals, as a good driver to kind of go through some of this. What do you think?
Sure. I mean, that building there is probably a little less value add than we usually do. What we like about it is it's a Class A building. But if you look at our going in yields and a price per square foot, I mean, we like to think that we're buying that Class A building is what we would say Class B pricing, right? So it was a high 6 yield going in. It's in Atlanta, as you mentioned. So it's a fully temperature controlled warehouse. So, that's going to add to the construction costs as well. When you start to get, north of $130, $140 a square feet for temperature control. So we like our basis in that property, 3% rent bumps. So we buy kind of around that strategy is we like to add value. And how do you add value? So for instance, the acquisition that we announced, I can't give you all the details. It doesn't close till next week, but we did file an 8-K on this the morning of NAREIT's opening day. And so that's a 1.9 million square foot portfolio. It's in our markets. It's in Cleveland, Columbus, and Cincinnati. As you know, we have a large office and a large presence in Columbus. We have our own construction development team there. We have our own property management team there, accounting functions in this location in Columbus. And so we take care of Cleveland, Cincy, Columbus, and Indianapolis from that location. We manage all of our own product in that market. And we like the vertical integration strategy. But that particular portfolio is Plymouth, front and center. That's 21 buildings. The average size is over 100,000 square feet. We got 75 tenants. The WALT is short, 3-year WALTs. In 10 to 20% mark to market. I mean, that's our strategy, and that's what we like to buy. And it's hands-on. You have to be built, I think, to manage that product to get the most value out of it, without having to scale up G&A to handle it. So we will drop those 75 tenants. Those 21 buildings will be dropped into our property and asset management team, and we won't miss a beat. I mean, we'll carry on for us. And so that's how we like to add value. Obviously make repairs as needed as we go through on those buildings, but we really like the location and we like the physical plant of all 21 of those buildings. And you can back that up to the $100 million portfolio we bought in Memphis last year. Same scenario. We had multiple tenants, multiple buildings. We sold a small office building, took that capital, rolled it into the call center, which we just got the certificate of occupancy 2 weeks ago. So now we have a 100,000 square foot building that's been turned into basically a brand new industrial facility. The call center, we don't need all that parking. And so now we can build a 115,000 square foot building in that parking lot. So we're not speccing it, but we're designing that out now. So that's how I think be able to work that portfolio over the last 8 months is required a team of people in Memphis, of which we have. So it's very seamless, and it allows us to do all these little value add pieces.
So my IR hamster wheel is spinning in the back of my head, and I purposely did not pull the 8K for this presentation because you guys didn't do a press release on it.
And we haven't
Because
closed
it
on
was
it
such
yet,
a
Dave.
massive deal, why didn't you put out a press release?
Well, because we don't close on it until next week.
And that's why you waited on for it to close
Right.
to do the press release.
But because it's $193 million check that we have to write at our size, that's material, and we have to file an 8K.
Okay.
So that's
I mean,
just,
when I saw that, I was like, wow, look at this. This is huge.
Yeah.
Great timing for our interview. And then I didn't see a
Yeah.
presser. So I appreciate you sharing some of the details of that. And I think in your valuation snapshot here, you unpacked a lot of that. Like you kind of reinforced some of the bullet points here as you're talking about why that portfolio fits right into the strategy. But can you maybe explain more about, tier two? Because I think it's a really, I don't really hear a lot of the other guys talk about tier one, tier two, tier three cities. Maybe what is your guys' definition here? If you could break it out a little bit more of what tier two means, especially since some of those markets you talked about, I would consider as a tier one.
yeah, I mean, again, this gets back to there's subtle differences here, but yet again, the industry doesn't do a great job of definition, right? We don't do a great job of it because remember, certain of our peers don't play in this space, so they don't need to talk about it. And so for us, it's funny. We also have on my internal list, we talk primary and secondary, right? So like a primary market, Atlanta, we consider to be one of the top primary markets in the country. Chicago is certainly a primary market. And the secondary markets are all kind of all the rest of them. But when you get into some of the other, like Avison Young, and some of the other big brokerages, they talk about tier one and tier two markets. So again, the tier two markets to us, if you're a foreign investor, a lot of times you're going to look at like, well, your investment criteria is going to be, well, tier one markets in the United States or tier one markets in Europe. So you're going to go by these tier one markets where there's bigger product. A lot of times there's much more liquidity in tier one than tier two. There's just bigger markets, right? And so if you need to get out of a portfolio, it's a lot easier to sell a portfolio in Atlanta or California or, in some of these other markets like Texas. It's a lot easier to sell a portfolio there than it might be to sell it in Indianapolis, right? Because there's only probably two REITs, publicly traded REITs, that are going to buy Ohio portfolios. We're one of them. Same with Indianapolis. There's probably one or two, and that's it. That's going to buy our type of product. Smaller product, shorter walls, a lot of opportunity to add value. So we don't have a lot of competition in the public REIT space.
Is that why 6th Street came on board because of that focus? Or is there more to the story there?
I think the overarching thing is that, when we met with them just a little over a year ago, they came in and they underwrote the entire company. They looked at 80% of our properties, they met most of our people, and they really said, we like Plymouth, and we want to do a strategic investment. We don't want to do a JV with you folks. We want to do a strategic one, which is, our minimum is $250 million of capital here. We believe in the company. We think it's undervalued. And we think if we can provide enough capital to you in the right way, and you can redeploy that into the right markets, the right growth, we think the stock's going to be, much, much higher than where it is. And so by doing that, we came up with a package, which was, hey, we have 6 million square feet in Chicago. It's our mature market. We don't manage our own properties there, right? So we're using third-party property management. So we're not losing anything by giving those properties up, if you will. And so they underwrote the Chicago, portfolio, and we worked out a 35%, 65% JV. We take 35, they take 65. They came in at a very attractive cap rate, provided us with over $100 million of capital, and then they provided $140 million of preferred, which to us at 7% at the time last year was a very attractive, market rate. I think a public preferred was going to be at least 120 basis points higher than that. So, and we had 140 million of proceeds. So when you take the 140, and you take the the other 110 to get to 250 on the JV, we were able to then refinance out another $100+ million out of Chicago, out of the JV refinance that came into Plymouth. When you put all that together, it was about $500 million of proceeds, right? So that's where we say look to deploy $500 million in incremental capital. So that $500 million, I mean, I think with this acquisition, we're going to be over 2/3 of the way getting that money deployed. And again, we're deploying it in Atlanta, we're deploying it in Memphis, probably Jacksonville, certainly in Ohio. Those are markets we manage our own properties, and we're buying what I would say is some more value add, really hands-on value add product. So it made a lot of sense from that perspective. Who knows where the relationship goes forward? It could take a couple of avenues, but they're definitely a strategic partner. We continue to evaluate more joint venture opportunities with them on new product, not stuff we own. So I think we can really leverage the capital in that relationship. And again, it's all about driving, value to shareholders here at Plymouth. Everybody in the company is a shareholder. Part of everyone's compensation is restricted stock. Management more so restricted stock, but happy to take it. And so we really think that if the JVs we can leverage our platform, drive fee revenue in here, and really add a lot of value.
So let's look a little bit towards outlook, and then we'll get to reshore, onshore. I got a couple more questions behind that. What can you share with us here? You talk about, the lack of availability is driving rent growth here. The sector dynamics remain strong as a whole, and your market growth is going to outpace the average. So maybe from a look ahead perspective, what could somebody who's watching this learn about what you guys see looking ahead?
Yes, I think if you look back, I mean, we just didn't have the double-digit, kind of crazy rent growth that some of the markets have had that have pulled back quite a bit, right, from that. So what we like about our markets, kind of back to tier 2, if you will, is that steady rent growth, right, with asking rents and contract rents that are still very favorable, right? Plenty of room to run over the industrial, set of properties that we own in our markets. So we like that. I mean, I think right now we're seeing a little bit of dislocation. Well, I know we're seeing it. A little bit of dislocation. We've seen some larger tenants take extensions. Maybe not renew for 5 years yet, but we're going to take another year, or we're going to go to the end of the year, take a 6-month extension. I don't know if I would say that that's tariff related. I mean, we have not seen anybody come to us and say, hey, because of tariffs, we're going to do X, Y, Z. May go on in some of the boardrooms, but again, most of our tenants, we know the owner of the business, right? A lot, outside of some of the really big tenants, and some of the Fortune 100s that we do have, we have a lot of tenants that this is their only location. We know the owners of the business, and it's mission critical for them. All 45 of their employees show up at this location every day, and that location needs to be functional and safe. Needs to work for them, and so we like that. We like that engagement with our tenants. So we do forecast that there's going to be rent growth. We do think a lot of the product, the bigger box stuff, starts to get absorbed next year, and we think the golden age of industrial. I think the long-term steady growth is still ahead of it. And again, a lot of it's reshoring, onshoring, but it's also cold storage. We need to rebuild our cold storage in this country to accommodate a lot more fresh food. So you hear that from the cold storage people, David. We talk about e-commerce, which goes into last mile distribution and all that. And then if we're going to reshore America and onshore it, onshoring, and close shoring and near shoring, there's a lot of different terms here, but whether it goes to Canada or Mexico, it's going to come back in the United States, has to be distributed, product has to be stored. We're going to reconfigure our supply chains. So all this, it absorbs industrial product, whether it's the land or existing buildings. And so whether we get the tenant in our building or not, doesn't really matter, right? It's that there's 5 buildings available, and if 4 of them get taken up by things that we don't do, then we'll get the 5th one. So this tide will lift all boats. They're not making any more land for industrial where they want it. I mean, if you want to go out in a cornfield with no sewer and no gas, there's plenty of land for that type of product. But where they want industrial, they're just not making any more land. In fact, it's getting zoned out. Places like California have said we don't want any more Amazon buildings. Parts of Illinois, again, in where you want these buildings where people live, a lot of people don't want it anymore. So again, we think that scarcity is gonna help as well. And again, and a lot of developers haven't built a small product. So most of our product is really in mature industrial parks where all the infrastructure is. And so we think that's a catalyst for growth for us. And so where we stand today, I think, is as we deploy the proceeds from 6th Street, and the markets start to recover all across the country as we head into 26, and maybe vacancy looks like it's going to peak here in early 26 and start to go the other way. I mean, rent growth is really going to take off, and I think as we look out 2, 3, 4 years in Plymouth, our NOI should be going up, significantly over that time period.
You've mentioned onshoring, reshoring, I believe 3 different times in this conversation already, and you obviously address it in your presentation. I think about another one of my buddies in the world of industrial REITs who spends a lot of time looking at onshoring and reshoring, talking about mission critical assets, just like you mentioned as well, where every employee shows up. Some of these manufacturing properties have been in place for 20, 30, 40 years that you just can't put a zinc pool on the back of a pickup truck or back of an 18-wheeler and move it down the street. Like, a lot of these tenants are locked in place. And we see opportunities, as you mentioned, of these jobs and industries coming back domestically here. I think you're a little bit conservative in this comment about 6 to 13%. I know the numbers are, there's a lot of numbers that are out there. But really, what does this look like? I feel like the onshoring, reshoring, maybe you will know better than I do. I feel like that chatter has kind of calmed a little bit over the past few months versus, let's say, a year ago. Are we really seeing this in effect? Is this happening before our eyes that a lot of these industries are coming back domestically?
Yeah, so there's a lot to unpack here when it comes to this, but I'll try to remember them all and go it. So the answer is yes. We've seen it across our portfolio in Atlanta. We've had a foreign tenant come in, from Belgium and lease some space for us. The thing to remember about this phenomenon is it didn't just start last year or 3 years ago. It started around 2012. That's when I first became aware of ReShoreNow.org. Harry Mosier set up the nonprofit for bringing manufacturing back to the United States. So this isn't a new phenomenon. We get asked a lot, this administration versus that administration. I go, this phenomenon is a demographic. It's a numbers-based phenomenon. It's based on demographics, right? The reason we moved all the manufacturing offshore was to save money. That was the primary reason. Might have been to get closer to where the raw materials are, certain supply chains or whatever. But remember, China got built up over the last 40 years because the United States moved its manufacturing offshore to save money. Well, like all good things, they come to an end, and the cost of doing business in China has gone up exponentially. There's a huge demographic issue, especially in China, where they don't have enough people. So wages on labor have gone up significantly. So you don't have the delta that you had. 30 to 40% save money, move to China. Sounded great. But now when it's 10% or it's even, you're taking a lot of risk to save a small amount of money. So this phenomenon is going to come back to the United States. It's not my opinion. It's not a we're not looking at our little globe here and trying to, prophecy this up. This is based on demographics, and you see it happening. And so again, back to, it is big. It could be much bigger than 6 to 13%. It's a guess. One thing I'd throw in here is, and we heard this a lot at NAREIT, was well, gee, there was a lot of announcements about the tariffs where, hey, this company's going to build $1 billion facility in Ohio or Indiana or Tennessee. And I would make the comment, those plans didn't come up in 2 weeks, right? Once Liberation Day happened, 2 weeks later, these companies didn't say, we're going to Lafayette, Indiana, we're going to build X, right? They didn't, they've had these plans on the shelf a long time. They just needed somebody or something to say, hey, time to take the plan off the shelf and put it in action. And that's what the Trump administration did, right? Hey, they called them out, you got to go do this now. So all these plans have been in place and they needed a catalyst to get there. So for the last 10 years, people have been trying to figure out their supply chain. COVID really impacted that. I mean, I think I say this a lot. I said, if you're Rip Van Winkle and you wake up in 20 years, you try to say, hey, guess what happened during COVID? One ship went sideways in the Suez Canal and it disrupted global shipping for 6 months. I mean, Rip Van Winkle would be like, that can't happen. The other one that happened is like the Ohio State Medical Center ran out of gloves, protective gloves. You say, no, Ohio State Medical Center, that can never happen. Well, when you manufacture all your gloves over in Malaysia and Indonesia, you can't get the product here and you can't get your insulin here. And you can't get all kinds of pharmaceuticals here because of global shipping. I mean, those things did happen and that can't happen again. So what we're seeing is a reconfiguring of the supply chain after COVID is ongoing. It's not going to be over. It wasn't over last year. It's not going to be over in 2 years. It's going to take years to reconfigure the supply chain and get back to a safer place, I guess, what a lot of people call it. Like, let's manufacture a lot of product we need here. Maybe it's not plastic toys, but maybe it's insulin, or maybe it's, we sold the building in Ohio, David, if you remember, in Columbus to American Nitrile. Pretty much had to sell them the building because they were putting, tens of millions of dollars into the building to manufacture nitrile gloves. Nitrile is a chemical like a latex. So they're one of the first manufacturers in the United States to manufacture nitrile gloves. They're doing it in Columbus. They can feed Ohio State Medical Center right up the street. And I will tell you that one facility cannot supply the demand for protective gloves in the state of Ohio for 1 year. I mean, they can make 1 billion gloves in that facility, and it will not supply enough gloves for just the state of Ohio for 1 year, that large facility. So if you go back and think pre-COVID, people made your sandwich, nobody wore gloves, right? People working in a hotel never wore gloves, for the most part, making beds and all this other stuff. Now, everywhere you go, food service industry, hospitality industry, everybody now in the medical industry is wearing gloves, even the front desk people, right? So everyone's wearing gloves. The demand for things is through the roof. We need to make that product in the United States. And I think that's my closing thing on reshoring and onshoring, that this is a phenomenon that's not going to change.
Separately, just me talking to you as a friend here, sounds like you should be writing a white paper about this. I think it'd be a great piece for you guys to put out. Just my 2 cents.
Yeah, right. We kind of have that, but I hear you.
You got about 10 minutes left, 10, 15 minutes left. I want to be respectful of your time and the close and everything. So I got a handful of rapid fires for you. For the average investor, let's not talk to your institutional peers because they know all of this stuff. But to the average guy, what are the keys to earnings growth and dividend growth for you guys?
Right. So, I mean, right now our dividend is our payout ratio is one of the lowest in the industry. I mean, it's around 54 to 60% AFFO, FFO. So, that's the range. It's going to change with these big acquisitions and what have you a little bit. So that's why I don't give out an exact number right now.
Right.
So the payout ratio is good. I mean, I think right now our stock is down, our dividend yield is up. I think we increased the dividend right today. No one's going to buy the stock just because of that, right? It's already a very attractive dividend. So, we don't look at it like that. So the coverage ratio is good. I think eventually we will, as we see in 26 and 27, as we start to see our NOI go up, I think you're going to see, the ability for us to raise the dividend. So we believe in dividends. We believe in growth. The thing for us has been, if you look at kind of where we were, we've kind of been flat. 23, we were $1.84 of FFO. We should have been closer to $1.90. We ended up 183. And that's kind of the law of small numbers, right? We're a smaller cap REIT. If we have two companies go bankrupt on us, we end up losing, 3 cents of FFO. We got to lower our guidance. The stock sells off, right? So, that's what happened to us. It's not a mystery. And so that's in Cleveland. Cleveland's one of the tightest markets in the country. We're already halfway back to leasing that space. We will get that space leased, and we're going to pick up, as we go into 26, we're going to pick up all that NOI, what's going to translate to FFO. Taking the 6th Street money, putting it to work takes time. I think by the end of the year, we're fully invested. You're going to see a major pickup you should see a major pickup in NOI, i.e. FFO, as we get through 26. We also have about 3% rent bumps across our entire portfolio. So we're going to see we should see a 3% increase in NOI just from that, right? So, and then add in these properties and the value add, and we're still getting mark to markets. If you look at our last press release, we're still achieving, cash spreads north of 10%. So, rents are going up on our portfolio over time just by rent bumps, but they're also going back because we're renewing people at higher and higher rates. And so that mark to market in this new portfolio is 10 to 20%. So I think for the next 3 or 4 or 5 years, you continue to see us ratcheting that up. And so this flatness in FFO, I think, if you look at the estimates from all the analysts, right, it's going up over $2, and we should be back on the FFO growth train as we head into next year.
One of my favorites for all the industrial REITs is always reading about the mark to markets and what those look like. It's always just eye-opening. You've briefly touched on tariffs, that you're not seeing the immediate impact yet because there's still a lot of, we'll say, uncertainty that's out there. And I know it's hard to, really put on the glasses and see this, but do you think tariffs are potentially going to impact you? I'm not saying how much per share or anything, but I mean, do you think there's more to come down in the world of industrial REITs and tariffs?
I mean, I've always had the position that these would get worked out, right? I mean, we are one of the biggest consumer markets in the world. China could be, and India can be too, but so everybody needs to be here. I believe that it would get worked out, and we saw a deal announced. I don't know anything about the deal, but supposedly we worked out something with China yesterday. So I think as we work these things out, it's going to kind of level this playing field, and I don't think there's going to be a negative impact. Now, I could be wrong. I mean, there could be some bankruptcies here and there, and again, as a small company, you get a couple bankruptcies could impact you, but we have not seen that for the most part. If anything, we have seen, initially with tariffs, we did see, anecdotally, people taking more space, tenants taking a little more space, right? We're bringing some product in ahead of this, but that's not a long-term solution. They can never bring in enough product for the next 5 years, nor would a business do that. So I actually think the impact in industrial longer term is going to be positive.
Okay. We've talked about dividend. We could skip that. So what keeps you up at night? You're doing pretty well. As you mentioned, you got restricted, unrestricted stock. You're a CEO.
Yeah.
What keeps you up at night?
I mean, I just think, access to capital to keep growing. This is a business. Public REITs today are a business of scale. And when you're $1 billion market cap, you really need to be 3, 4, 5. So we continue to work towards, getting the growth into the stock so that, the market gets the stock back up where we can issue equity accretively. I mean, we're not going to do dilutive equity raises. We've said that publicly. The life of a public REIT, a lot of times up until about $1 billion market cap, you kind of do some dilutive equity raises at times because you got the growth, and so right now we're just focused on deploying this capital, leasing space, collecting rents. That's our focus. And so just access to capital is really what concerns me.
We did see, obviously, not in the world of industrial, we did see an office REIT do a dilutive offering yesterday, a massive deal, as you know.
Yeah.
We have seen a lot of REITs raising dollars. I think we've had 6 different guys raising money this week alone. multiple billions of dollars. I don't have your debt stack up on the screen here. I don't think I really got into it, but are you guys looking at the debt market currently? Is there opportunities out there for you since the market's wide open, at least on the lending side?
Yeah, not really. I mean, we're fully hedged across most of our debt. Our credit facility, we have plenty of capacity on there. We took the Sixth Street capital and paid down, so we're gonna take from the line, from our credit line, and we're gonna buy, some more assets and another acquisition, some acquisitions pending in the next probably 3 or 4 months. So that's it. I think we'll be fully deployed on that. We continue to play in the 6x net debt to EBITDA. And as our EBITDA goes up next year, we're kind of naturally deleveraging from that perspective. So I don't think you'll see us add more debt to the debt stack.
Okay. The softball question, I have one audience Q&A, and then I believe we're going to be good. So I asked you this when we did the 5 and 5 interview, and you gave a great response. And, again, I can't have management teams stress this enough because you've got to differentiate yourself versus your peers and emphasize why you guys do what you do in the world of REITs. So why Plymouth, and what is the value proposition of Plymouth looking at this year and beyond?
I mean, I'm going to step back from just the growth profile, which I think is there, right? I've identified where we're going to fill the holes here in the leasing. We buy new product. It comes sometimes with some vacancy. We're good at leasing product. We'll get all that leased. I mean, I think all this product that we own is going to get leased up. I don't worry about that at all. So I go back to the value proposition. Look where our stock is trading today, and then look at the consensus NAVs that are in the market, right? And they're all mid-20s. So if we're trading where we are today and the NAV is there, and it has to be a good NAV, right? You have to use real NOI and you have to use a real cap rate. We're going to use a cap rate. We're in the market. We told the world that this next acquisition would be between 6.5 and 6 3/4. You can see the one in Atlanta was higher than that. So, we've been in that 6 3/4 range. So I think if you cap our forward NOI, I think you can just see where the value of the real estate is. And it's industrial. So it's really simple to value because industrial rents are going up, right? We're not in this funk where they're going to be going down for the next 20 years, which, kind of office has done for the last, 5 or 6. So I think we're in a good spot from there. So I think the value is in where you think the stock is worth and where it's trading today, right? I think if that plays out and we come back and the stock moves back to where it should be, then you have all these growth drivers on top of it that we've alluded to.
We got a great question that is a little bit outside the box, actually. I don't get asked this question a lot. So Tony, kudos to you on this one. So let's throw out the ETF guys, the BlackRocks, the Vanguards, the State Streets.
Yep.
Tony says your proxy shows your top 4 shareholders are very unusual for a REIT. Can you talk about maybe how that came to be and what are both the advantages and disadvantages of this? And for those that aren't looking at this right now, I'm looking at my Bloomberg, and like I said, ignoring the ETF guys. Westwood, Madison, Prudential, Jennison, Silvercrest, Macquarie, Geode, which used to be a side of Fidelity, and Ameriprise. That's like your top holders list. Can you maybe talk about how that came to be?
Yeah. So Madison, we did a $75 million preferred with them. I don't know, 5 years ago now. It's hard to remember, when you all these times. But about 5 years ago, we did a preferred. We bought our entire portfolio of Jacksonville with their capital, similar to a Sixth Street, right? It was a strategic investment into the REIT. We took that, we bought a portfolio. They converted into common stock. So that's how we didn't have to pay off their preferred. They decided to convert it into common. So that's how they became, I don't know what they're showing up as, a 7.8 or 8% shareholder of the company.
7.8. I mean, good, right on. 7.8%. Yeah. Good job.
Yeah. So they're there. They're a private equity real estate, if you will. They're in. They hold their stock. Again, underwrote the whole company. We did several JVs with them. I think we did 3 of them. We just closed one out early in the year in down south. So they've been a good partner on the JV side with us. I mean, Jennison Prudential, you know, we talk to them a lot. They're stock buyers, quite frankly. Westwood's been a long time investor of ours, so we know them fairly well. When you get
what about Silvercrest, without saying too much, because I'm not familiar with them really.
Yeah, I mean, they were part of a family office, so big asset management firm. Again, take positions. You know, they're not a hedge fund. They're not traders per se. They take positions long term, but you know, they bought the stock in the open market. The only one that didn't is Madison. You know, Madison came through a preferred, but everyone else has been a buyer of the stock. So yeah, good. Those are good holders. We spent a lot of time with them. I think they believe this math that I'm talking about. You know, that the math works, and we pay a good dividend while you wait for that math to work.
Well, Jeff, we've hit the top of the hour here, and I can't thank you enough for giving up an hour of your busy day unpacking all of this data. For those that are listening, you guys are reporting earnings here in the near future. Off the top of your head, do you know what the date is?
Yeah, it'll be sometime, I think, the beginning of August. I don't know if the date
Beginning
is
of
off the top
August.
of my
So
head, but
stay
yeah.
tuned for second quarter earnings. We look forward to hopefully seeing this press release hit next week if the deal closes. And again, from all of people on my side, from myself and everything, can't thank you enough for taking time out of your schedule to chat with us. We really do appreciate
Thank you, David, and anytime. Let's do this again.
Thank you, sir. We'll talk soon.
Thank you.
Bye-bye.